Right. Good afternoon. So, um, today the Zoom session is the last one because the next week I'm going to invite one of your one of our successful alum who is in the real estate industry as an executive, and he agreed to come. The online virtually. He agreed to come and speak to our students who were in real estate, the minors, or in the class, or anybody who are interested in that area, that industry. So he agreed to come next Wednesday, 3 p.m. Right, this time next week. Right. He is really good speaker, and he's successful real estate executive. Right. You love his speech, and his speech is so good, and then very caring, very good advice, and then you love it. I love it. I decide to have him as our permanent executive speaker for the rest of the years. So he's good. All right. So we'll finish up the everything about the bond today, bond valuation and the bond yield and the bond duration. These are all basic, fundamental skills and understanding for you as bond portfolio manager. Okay, so if you understand all this one, and if you solve those questions yourself, then you will be in good position. Right. Now, bond, as you know, is a loan made to the issuer by investors. So if a corporation issue bonds, then investors buy that. That means the investors, they lend their money to the corporation. Okay. And this bond is the evidence of that loan. Okay. And then once you hold the bond, the investor's bond, the corporation, the issuer, they agrees to pay fixed amount of periodic interest to the holder. So typically every 6 months, but sometimes 1 year, and then repay a fixed amount of principal at the end of maturity. So those two are cash flows that you will be expecting from the corporation, the issuer. So as you know, coupon, term to maturity, principal, par value, and type ownership, those are basic components in this bond. And bond issuers include the corporation, and then government, and then state government or local government. And especially the bond by state or local government is called municipal bonds. Right? This municipal bond, they are free from the tax, free from tax on interest, bond interest. So if you hold this municipal bonds, you don't pay any state tax, federal tax on the interest income. So that's the beauty of these municipal bonds. So many banks and insurance companies, pension funds, they love this munis. Okay. Type of coupon, the interest distribution, coupon interest distribution. Whereas the coupon bond, when you learn about the bond in 313, I believe you heard about coupon payment every 6 months or 1 year, and then later on par value at maturity. So that kind of coupon bond is called coupon bond. It's the old style interest distribution. So basically, if you have the 10-year bond, suppose that corporation pay interest every 6 months, then the company will send you 20 coupons. Then every 6 months you take one coupon, and go to the bank branch that is indicated by the other corporation, and you give this coupon and receive the coupon interest. See, that's the old school way, right? Old school way. But this old school way is used for discussion or analysis purpose there. But in some the bond market in Europe, in Swiss, they don't want to present their identification. They just want to get the paid for the bond interest. So in that way, some of the European market and the Swiss market, this coupon bond, these bearers are still popular in that way. If you understand that, right? Now, most corporate bonds, they are called registered bonds. So if you buy corporate bonds, you have to register yourself with the corporation, and you provide the mailing address, and then every 6 months they will mail the coupon to your mailing address. That's called registered. So registered. Book entry is about the government securities. This one more than registered. Book entry, you have to provide your bank information, your identification, and your bank information. Then the coupon interest will be mailed to direct deposited into the bank account. So that's about the government securities. It's called book entry. All right. And secured versus unsecured. Secured bond. This is about the secured means the priority of this bond interest payment. So when the company has earnings, they will pay this bond interest. But this bond interest will come to the holders of secured bond. Secured bonds, we have the mortgage bond, collateral trust bond, equipment trust certificate. Mortgage bond is in our real estate industry. Collateral trust bond is in finance or investment industry. Equipment trust certificate, that's in like transportation. Okay. Debentures is unsecured bond. Secured bond are secured or backed by some kind of property. In mortgage bond is backed by the real estate property. Collateral trust bond are backed by the investment, the financial investment, security. And then equipment trust certificate is backed by the transportation vehicle. All right, that makes sense, right? Debentures are not backed by anything. It's just backed only by the promise of the issuers to pay interest and the principal on a timely basis. So generally, secured bonds are more like stable, safe. Debentures are not stable. That's the common understanding. But not necessarily, I would say, not necessarily, because debentures, the issuers of these debentures are unsecured bond, right? Small company or local companies, they cannot issue these debentures because nobody would buy these bonds, right? The only corporation, the companies that can issue these debentures are big companies and widely known companies like Coca-Cola, IBM, Ford, right? AT&T. Only those widely known companies and big, large, stable, established companies can issue these debentures. So then investors, they will buy that. They buy these debentures. See, the difference between these two is, secured bond, because these companies, they need to raise capital, small companies, even small companies, they need to like raise capital. They issue secured bonds. So, but if their bonds are not secured by anything, then nobody would be interested in buying that. So secured bond. But debentures, the only like large, big established company can issue these debentures. So the corporation, these debentures are not that like dangerous. Okay, they are still safe. So that's tricky point. I mean, generally debentures are not stable, are not safe, but not necessarily. That would be my answer. Call provision is if the bond has call provision, it gives corporation issuer the option to redeem the bond before the maturity date, but at a call premium. We'll talk about this one. Non-refunding provision. Non-refunding provision that prohibit a call or premature retirement of the share. Okay. Sinking fund specify that the bond must be paid off systematically over its life. As I said, if you are bondholders, bond investors, you are guaranteed two cash flows. One is periodical, 6 months. Every 6 months, you get the bond interest, right? And then at maturity, you get $1,000. I mean, $1,000 the face value, right? Par value, and $1,000. But if the company issue a number of bonds, then that $1,000, the sum or total sum of that the face value payment will be significant. So that would be a big issue for a company. So they set the sinking fund and to pay off like step by step, systematically over its life. That's called sinking fund. All right, global bond market. The market for fixed income security is substantially larger than the listed equity exchanges. That's much larger. First, this bond is a cost of debt. Cost of bond is cheaper than cost of equity. First, and then many times this like issue or bond issuing can be made directly between the company and the financial institution, company and like pension fund directly. So it's easier, not going through all this like investment banking form, go through investment banking form and follow the old procedure and requirement and regulations. This bond issuing could be made easily. But if you look at this one, 2019, the size of the equity market and bond market, bond and municipal. So look at that. This is incomparable, right? Bond market, the size is much bigger, 91% and 9% for equity. So participating investors, there are individual, institutional investors that include all those life insurance company, banks, and insurance company, pension fund, mutual fund, right? Tax code and nature of the institution, liability structure, those are the factors influencing the institutions. All right, bond rating. Bond rating, there are two like worldwide known rating institutions. One is Standard & Poor's and Moody's there. So they are similar, but their rating system is slightly different, right? So AAA, AA, single A, triple B, double B, single B. That's Standard & Poor's. Moody's, triple A, double A, single A, same way, but small letters, and BAA, BAB. So slightly different. Okay? different. And investment grade bond, the triple B, that is the important rating because triple B and above are usually called investment grade, or double B or lower is called speculative grade or junk bond rating, right? Junk bond rating. So, triple B or above, since that's the investment grade, that's a normal. But if your companies and some companies bond rating is in junk bond rating, then investors would not buy those. So what they need to do, what they should do is they have to provide better and more payment. So usually their coupon interest payment is higher than investment grade. Otherwise, nobody would buy that. So to attract investors, they have to, provide higher investment rate. So, for example, if a corporation in the investment grade, they offer like 7% interest, coupon bond interest, then this like junk bond, they have to pay like 9%, 10% or higher. So that's disadvantage. And bond safety, that depends on these ratio groups: coverage ratio, leverage ratio, liquidity ratio, profitability ratio, and cash flow to debt ratio. Those are major, bond rating or safety determinant. Okay. All right, bond yield. Let's talk about this. Okay, there are several like bond yield. Right? Normal yield, that's coupon rate, like 7% coupon rate, 8% coupon rate. That is used to determine the coupon payment, right? As you know, every 6 months or every 1 year, this coupon rate will determine the amount of the coupon payment to investors. And current yield is just coupon divided by price. That's current yield. But those two are not like precise like bond yield. The real precise bond yield is called promised yield to maturity. All right, let's handle this one. We have 20-year bonds. We have 20-year bonds, and with the 8% coupon paid annually, 8% coupon paid annually, the price at the $900 in the market. Oh, here. Now 8%, that is, as I said, that is the coupon interest that is used to determine the coupon payment annually, right? Annual. So the 8% coupon times par value, that will be the annual coupon payment. So 8% times 1,000, that's $80 will be paid every year, okay? And another cash flow is $1,000 at maturity. So the last year is $1,080. That's the payment. Now, to buy this bond, the bond with this cash flow, you have to pay. I mean, the current market price is 900. So minus 900, right? The reason I put minus sign is that that is your payment. Now, you want to solve for, YTM, yield to maturity. So let's put it there. To solve yield to maturity, you have to solve for I. Okay, so this one, using Excel, you have to start with this one. Rate, right? Rate and period, that's 20. Let's assume that the coupon payment is paid annually. Payment is $80, and present value is minus 900, and future value is $1,000. 1,000, right? So that's how you solve for the yield to maturity on Excel. What do you have here? 9%. 9.10%, 9.10%. That is the promised yield to maturity. Okay, all right. Now here, suppose this bond has call provision. So the firm has the option to call the above bond in 10 years at 950. So the cash flows will go this way: $80, $80, every year $80. But at the end of 10 years, you will receive 950 instead of the $1,000, right? 950. That is the other cash flow that you will be receiving from this, callable bond. And you already paid $900. All right. Okay. Let's calculate here. Now you solve for I. It's called yield to call. Okay. Yield to call. So yield to call is okay. Oh, by the way, this one is 10. Yeah, this one is 10 year, right? So because the firm has the option to call the bond in 10 years at 950. Be careful, okay? Careful. So yield to call is rate. And period is 10. This time is 10. Payments $80, and then minus 900. And then instead of $1,000, you have to put 950, right? Got it? Here's a little bit tricky. All right, this. Get this one. Is the yield to call? Yield to call is 9.25%. So it's higher, slightly higher than 9.1%, right? Because the company should provide some call premium when they do this, when they call this bond before the maturity. So they have to pay slightly higher, premium, right? Now, horizon yield. Let's talk about this one. 25-year bond. You invest in a 25-year bond with the 10% coupon paid annually. The investors' required return is bond interest, 12%. Coupon bond price. The bond price is okay. Now, 10% coupon rate. I told you that is used to calculate the coupon payment. So 10% times par value, $100 is your annual coupon payment. So it will continue every year. And then this is 25 years, and in the 25 year, you will receive 100 plus $1,000 via the par value. Now, given the bond interest rate, 12%, what is your price? Bond price, bond value. Okay, that's the question. So to calculate this one here, what you do is present value, rate is 12%, and period 25 years, and then payment is $100 and par value $1,000. That's how you calculate. So calculate right there, $843.14. So for this bond with this payment and interest rate, the bond price that you pay to get this one is $843.14. Okay. All right. Next, analysis of the economy and market. Based on the analysis of the economy and the market, we project the bond market yield to maturity. This bond interest rate, market interest rate, will go down to 8% in 5 years. In 5 years. So we're talking about 5 years later. Now, what would be future bond price then? All right, bond price, future. Now, the first one, if you look at the first one, since we have the 25-year bond, we showed all these years up to 25. Now, in 5 years, the time horizon will be 1, 2, and this one will be 20 years, because we're talking about the 5 years later. And 5 years later, based on the economist projection that interest rate will go down 8%, what would be your bond price, bond value in 5-year future, the 5 year? So this is how do you calculate there. Now, we're talking about 5 years later, rate will decrease down to 8%, and period, the remaining period will be 20 years, not 25. Payment is same thing, 100 and 1,000. Okay. All right. So that is, wait a second. This. A little bit this way and yeah, all right. If bond interest decreases down to 8% in 5 years, then your bond price will be $1,196.36. Okay, but if we look at this one here, one important thing, as you probably remember, the bond interest goes down. What happened to the bond price? Bond price goes up. So interest and bond price, they move in the opposite direction. They move in the opposite direction. That's important, idea. Now, so initially we got the intrinsic value, bond intrinsic value for 25 years, but the economy and the market analysis that tells you that bond interest will go down from 12% down to 8% in 5 years. So based on that projection, we calculated future bond price in 5 years, right? 5 years later, it was $1,196. So it's quite increase. Now, if that is your projection and forecasting, what would you do? How would you use this information? Simple. You paid $843, but in 5 years, the projected price is $1,196. Then, in 5 years, you want to sell it. So, if you decide to sell the bond in 5 years, then what is the realized on the horizon yield? Okay, all right. Oh, by the way, this one is get rid of this. We are solving for that. Now, you initially paid how much? You paid $843.14 to buy this one, right? And so on. And the coupon interest will $100, but in 5 years you will pay and get how much? You get $1,196.36. Yeah. All right. So if you use this information and if you decide to sell this one in 5 years at the pretty good price, attractive price, then what is your yield? Not yield to maturity. What is called the yield for this transaction? It is called horizon yield or realized horizon yield, right? So realized horizon yield is, see, you do this way. First, you are solving for rate, right? Rate and period 5 years. Payment 100, okay. present value, that's your original price, minus $843.14, and future value you have to input that $1,196.36. That is how you solve this for price and yield. So what do you have? It is 17.76%. is much higher. It's very attractive, right? Very attractive. That's a realized yield. That's how you solve. All right. Bond pricing. Okay. I think we did this one here, right? For example, if the bond pricing, the coupon rate is 8%. 8%. So let's assume coupon rate is 8%, and bond price, right? And then if the bond interest is 8%, the bond value is $1,000. And if bond rate is 6%, then all right, let me show you how to solve this one. For example, 10-year. Bond value is present value, right? Present value. Rate is 6%. 6%. And end period is 10 years. And then the payment is $80 because 8% coupon. And then $1,000. Okay, simple. See there? That is minus 1,000. Okay, let's get rid of minus sign. Okay, so that's how you calculate a bond value. Right? This one, see, present value. Well, rate is 10%. Bond interest rate is 10%, and end period is $80, and payment no, it's not $80. It's 10 years. 10 years, $80 and 1,000. Okay, you see that? I just enter the menu, right? That's 10%, 10 years, and payment is $80 and 1,000. That's par value, and you get this number. And again, let's put this minus there. So the minus sign is not important there. This is bond price. Bond price. We calculated this bond value for 20 years, 10 years, and 1 year, right? And then, and also over 3 different interest rate, bond interest rate, 6%, 8%, and 10%. Okay. Okay. Let's see how I would explain this. If you look at this one here, let's look at the 6% case. 6%. This one, all the bond value is above 1,000 par value, right? This one is called premium bond. Premium bond. And then if it's same as par value, just par bond. And then if it is lower than par value, is you go discount bond. All right. Now, if you pay attention to this one, the changing pattern of each bond, what do you see? Let's start with the 6%. 6% was like $1,229, but that is for long-term 20-year maturity. But after 10 years, if it has 10 more years to go, it the decreased down to $1,147.20. Another 9 years have passed, so that we have 1 year remaining maturity. What happened? $1,018, $1,019. If you look at discount bond, if it was 20 years, 20-year bond, and when 20 years to go, it was $829, $830. Now, in another 10 years, like, so that we have 10 more years to go to maturity, what happened? That bond value increased, bond price increased to $877. And then another 9 years passed with the 1 year to go to maturity. What happened? $981, $982. You see that? Premium bonds that the price that decreased over time. Discount bond, the price increased over time toward maturity. So what do you think at maturity? What do you think? What do you think would happen at maturity? Okay. What do you expect at maturity? Looks like premium bond will continue to decrease, and at maturity, it will mature at par value $1,000. Discount bond that start to increase, and at maturity, it will mature at $1,000. So they are like, converging toward the par value, right? Okay, that was one observation. Now, look at the second observation there. So all the bonds converge, okay, toward par value. If you look at each row. Now look at the 20-year bond. Let's compare 20-year bond and 1-year bond. Now, those column. Now let's look at the column for 20-year bonds. Start at 8%. When the bond interest that decreased from 8% down to 6%, what happened to the bond price, bond value? That increased by $229. When bond interest that increased to 10% from 8%, what happened? Bond value decreased by about $170. Okay, so we can interpret this the price change that way. It's like, the bond price sensitivity to interest rate change, right? So when interest rate goes up or goes down, what happened to bond value? So that's exactly sensitivity of bond price to the interest rate change. Now, if you look at the 1 year, look at this. That also shows the change, right? Bond value changes when interest rate decreases or increases. Now, what do you see between these two? You see the size of change or the magnitude of that sensitivity is much higher for 20-year bonds, right? 1-year bond is just change, $18, like, $19, $18 around. But the 20-year bonds, it shows like $230 and $170 there. See that? The sensitivity, the change, the size of the change of bond price to the changing interest rate change is much larger for, long-run, long-term bonds. That is interesting and important idea, important concept in bond analysis. Okay, now with having that in mind, interest rate change. Yeah. Okay. Interest rate change. All right. Interest rate risk. Okay. All right. Alison, can you read the first two?
Bond prices and yields are inversely related, and long-term bond prices are more sensitive to interest rate changes than short-term bonds.
Right. Now, we know this, yeah, right? Bond prices and yields are inversely related. So when the bond interest rate goes down, the bond price goes up. So interest rate goes up, bond price goes down. That's the first one. Second one is long-term bond prices are more sensitive to interest rate changes than short-term bond. We just checked it. We just know that. Okay? And the Rachel, 3 and 4.
Okay. Interest rate risk is inversely related to bonds coupon rate. Low coupon bonds are more sensitive to interest rates. Increase in bonds yield to maturity results in smaller price change than yield decrease of equal magnitude.
Okay, we don't know this one, right? It's a new things, new properties. We don't know that, so we'll find out, right? Harry, can you 5 and 6?
As maturity increases, sensitivity of bond prices to changes in yields increases at a decreasing rate, and sensitivity of bonds price to yield change is inversely related to current yield to maturity.
Okay. We don't know that yet either, right? So let's figure it out. Let's find out. So we have this, 4 different bonds. Okay, 4 different bonds. One is the 5-year bond, the rest is the 30-year bond. And coupon interest is 12% and 3%, yield to maturity 10% and 6%. So when you calculate the bond price, the first one is $1,075, second one is $1,188, third one is $340, and fourth one is $587. Okay, that is here. That is here. Okay. Yeah. And what I did here in Excel, now when bond price decreases by 1%, so bond price, now bond interest rate decreases by 1%, that means interest rate is yield to maturity 9995. You see what I mean? So when interest rate goes down by 1%, this is our, bond. Oops. This is our bond value. This one is when interest rate goes down 9995, and this one is 3%. So 7773, right? Then this is the price, and this one -5. When goes down to 1%, we have a new the bond price, and the opposite too here. When bond interest rate increases by 1%, so 11,11,11,7, then this is our new bond price. This one 3%, so 13%, 13%, 30%, 13, and 9%. Then this is our bond price. This one is last one is 5, 15, 15, 15, and 11%. We have this bond price. Okay. Now, so you see what we did so far, right? Now, based on this value, we calculate what? The percentage change. So starting with the this center value, now this one is how we calculate. So it is percentage change in this bond price. So this one minus this one divided by this one. So that is 4%. I think this one should be like a little bit, yeah, 3.880%, right? So let's okay, let's put it that way. All right. Okay. So I mean, I could do this one, copy and paste, right? Oops. No, not this one. Not this one. So these four are what? They are okay. They are the percentage change in the bond price. Okay, here. Let's see. Okay. So if you calculate everything this way, and you can calculate this on the whole thing, and then you show all these four bonds, like the percentage change in bond value. You can, if you show the graph, for again, this is -1%, -2%, and 3%, 5% this way. And A, if you look at A is blue here. Blue, that is A, right? A is the change. Okay? And then this one is this red one. C is this green one, and this one is purple one. That's D. All right. Do you see what we did so far, right? It's just a manual process, and all this solution is shown on the graph. Now, let me show you. Okay, now let's look at the graph, and okay. Oops. Okay. Here. Now, let's compare A and B. A and B. A and B, the only difference between A and B is long-term bonds, right? Long-term bonds. So if you compare A and B, this A and B, this the blue A, B red, what do you see? I mean, by the way, I mean, this one, percentage change in value is what? Is called, I mean, you can say bond sensitivity or interest rate risk. Okay. So if you compare this to AB, then let's just compare AB. One is B is long-term bonds, A is short-term bond, intermediate bond. So when you go long-term, what happened to the this percentage change? That's much higher, right? So long-term bonds shows much larger interest rate risk. So, the others are all the 30-year. The others are all 30-year. So, long-term bonds, I mean, directly A and B, because that's the only change. A and B is long-term bonds shows, much larger interest rate risk compared to a short-term bond. Now, let's compare B and C. B and C both are long-term bonds, 30-year bonds. The difference is C has the lower coupon rate, right? So C is this green, and B is this the red. So what do you see? Lower coupon rate. The bond with lower coupon rate has higher interest rate risk, higher sensitivity. See that? So interest rate risk is inversely related to bond coupon rate. That's what I mean, right? Low coupon rate has higher interest rate risk. That comes from B and C. And C and D, look at this. C and D is the same thing, except the bond interest rate is yield to maturity is lower for D. So C is this green, and D is this purple. But the only difference between those two is that the yield to maturity, bond yield to maturity is lower for D. But we see D has higher interest rate risk. Okay, so interest rate risk is no. Interest rate risk is inversely related to, somebody took it, okay? That was related, current yield to maturity, right? See, it was related to the yield to maturity, current yield to maturity. That's what we see this one here, right? D is much higher. It's much higher. Okay, so this one we took care of it, and this one we took care of it. This one we know. This one we know. So this two. Let's talk about this. Price increase due to yield decrease, right? When yield to decrease, the price change, the size of price change, and compare that one, and then price decrease when yield increases, the interest rate increases. Which one is bigger? The price change due to the interest rate decrease, this one is bigger. So this one goes more than this one. This is flatter. This one is steeper. That means the price change due to yield decrease, that size is much bigger than this. Price change due to the yield increase. So that is about this fourth one. Then, fifth one, interest rate risk is less than proportional to bond maturity. All right. All right. Look at this one here. Now, this one is 5-year bond. This one is 6-year bond, right? If this one is like exactly proportional to bond maturity, then this one should be like 5 and 6 times bigger than this one. But it is not. If you look at this one here, these two are not 6 times bigger. This one not 6 times bigger. So that's what that means. Interest rate risk is less than proportional to bond maturity. That's what that means. All right. So we proved all these 6 property of related to the interest rate risk. So when you do this one and you look at this one and do it over and think it over, then all this one, you'll find all this one makes sense. Now, bond trading strategies. Now here, I mean, this basic property, using this basic property, you can come up with nice short like intuition there. Look at this. If interest rate decreases, this area, right? If interest rate decreases, what do you see? I mean, the bond price will increase, right? Increase. So when interest rate decreases, then we know that bond price increases. Now, that's good news for you, right? The bond price increases. That's good news. That means you have the free lunch, right? Yeah, free lunch there. But you want to make that the free lunch much. I mean, as much as possible. How would you do that? Then you have to use this idea. The first one, long-term bond has larger interest rate risk than short-term bonds. So when interest rate goes down, when your projection is that interest rate will go down in the next year or two, then what do? You will get profit. Your bond price will increase, but you want to maximize it. So what do is you want to include more long-term bonds in your bond portfolio. That should be your strategy. A bond portfolio with long-term maturity with low coupon, and of course the coupon should be low, then that will maximize your interest rate sensitivity to your benefit. That's true. This simple idea that provide very powerful, interesting, powerful bond strategy, bond value strategy. So when this one is your projection, then what you do is you trade bond and include more long-term bonds in your portfolio, and more long-term with low coupon interest rate. Then your profit, your delicious free lunch will be maximized. Okay, that makes sense, right? Now here, when your projection is that your interest rate will go up, then what happened? Your bond portfolio will be bleeding, will go down, right? Now, if you expect your bond portfolio will go down, then what do? You want to minimize that bleeding. How do you do that? You want to include the bond portfolio with short-term maturity with high coupon interest. That way, you will minimize the interest rate sensitivity. So you minimize your bleeding. Well, that's another important piece of bond trading strategy. Yeah. So that comes from our understanding from this basic properties. Yeah. Bond duration. Bond duration is related to interest rate risk. So let me step by step. I'll show you step by step. Yeah. Right. Duration. There is two different duration. One is a Maclaurin duration. The other one is modified duration. Right. Maclaurin duration is this one here. Is the effective maturity of bond and the weighted average of the time until each payment, with weight proportional to the present value of the payment. So basically, this Maclaurin duration, this bond duration, whether it's Maclaurin or modified, it gives you very useful and powerful tool of your portfolio management and risk management. Yeah. How do you do that? Let's do this one. Yeah. I mean, let's talk about this. How do you calculate the bond duration first? 8% coupon interest, 8% coupon bond with the 8%, 3-year bond with the 8% coupon. So payment is, each annual payment is $80, right? 8% coupon, $80. But at maturity, you get 1,000 par value, and that one here. Now you calculate present value. Present value is 80 divided by 1 plus bond interest is what? 10. 1 plus 10, right? That is your n. Let's do this one. To the 1. This one here. So that is the present value. You see what I did? Okay. And then, since you use this one here, you can copy and paste. Let's do one more. This 80, let's calculate present value. 1 plus 0.10, 10% to 2 years. Okay, that's a discount rate. What is this? This one is the 10, yeah. This one is the 11. So oh, whoa, this one should be 0.10, right? 0.10. Okay. And then since you used all this Excel, copy and paste, that will give you your present value. So your bond price is what? Bond price is sum of this present value, right? Sum of this present value. Yeah. So $950.26 is the bond price. Let's see. Let's get this one down this way. Okay. So bond price, bond value is the sum of all the discounted value of your future cash flows. That is $950.26. Now weight, this is how to calculate. Weight is your present value out of total present value, right? And then this one is also this, this present value divided by our total present value, and this one divided by total present value. So that is how you calculate, weight. Okay. Now the next step, final step is just multiply this on 1 year times weight, and let's do the same thing for this one here, right? Now duration is the sum of that here. Look at this. Duration is sum of this time. It is a t times weight. So sum of this is one is your numerical duration. That's your duration. So 2.7774. That is your bond duration. Okay. All right. Now, what about the zero coupon bond? That means this one does not pay any coupon interest. So 0, 0, and at 3, and at the end of maturity, you get $1,000. So present value. I mean, let's just do copy and paste, and then this one too. Copy and paste. All right. Okay. So this zero coupon bond, the bond value is $751.31. And let's calculate weight. Just simply to save time. Copy and paste. And here, look at this one, 001. So same way, copy and paste. Here we have 003, and then sum of it here is 3. There, do you see that? So zero coupon bond is that the maturity is the duration. Maturity is duration. But 8% coupon bond, maturity is not the duration. Duration is lower than the maturity, 2.78 years. 2.78 years. I'll show you why that is important. Okay, and practitioners, they often use the duration called modified duration. Right? Modified duration. All right, how? Essential tool of immunizing portfolios from interest rate risk. I'll show you what that means. The measure of the interest rate sensitivity of bond portfolio there. Look at this. This is the formula for the modified duration. So modified duration, it is, here look at this, D star is the duration, backlist duration, divided by 1 plus y, 1 plus y, right? So here, modified duration of for 10-year bond with the 8% coupon interest annually, interest rate is 9%. Okay. All right. You know what? Since here, you don't have to go through this one here. Let's do this one here. Now let's calculate the present value. Present value rate is 9%, and then end period is 10-year bonds, and then payment is 8% coupon, $80 and $1,000. Okay, that's par value. So what do you have here? Now $935.82. That's how you calculate. Okay, how you calculate. And if duration is given for you, you can calculate duration like this. You know what? Let's do it. We have time here. So 1, 2, 3 here, and this one goes to 10 years. More. Okay, 10 years. And what else? I mean, this is the coupon payment, right? Payment. So here, $80, $80, $80. Every year you get $80. Why don't you do it on your Excel, right? Why don't you repeat the same thing? And present value is, this one 80 divided by 1 plus 0.09, 9%. Oops, 9% to the 1 year, right? And if you use that one here, you just copy and paste. By the way, the last year it should be 1080, right? 1080. And then sum of this one, sum of all this present value, that should be equal to $935.82. If not, we're in trouble, right? Look at this, $935.82. That is exactly bond value for this 10-year bond with the 8% coupon interest, given YTM of 9%. Now, weight, let's calculate weight. Weight is what? This present value to this one here, right? But since we have to fix this one, the dollar sign on there. You see what I did? That one. Copy and paste. Excel is good, right? It's very convenient and useful and powerful, actually. So that is the weight, and then weight times T times weight is what? Well, simply this T times weight. And then copy and paste. See? All right. Then the duration, Macaulay's duration is, so they say now D is equal to, so that's see this way, is a sum, just simply sum of all this one here. So what do you see? It's a 7.146. That's exactly this one here, right? Got it? That's how you calculate this duration. Now, here, given this one, that's we got this. Now, the question is, what will happen to the bond price if the yield to maturity increases to 9.1% from 9%? So increase 0.1% increase, what happened to the bond price? You might like go back here and put the 9.1% and repeat the whole process, but you don't have to. Look at this here. It is, if you use this formula, then you can get that one here. Now let's calculate D star first. D star is, as the modified duration is this one, 7.146. This one divided by, oops, okay, all right, here. This is 7.146 divided by 1 plus, what is the interest rate? 9%. That is your modified duration, right? Modified duration. So what happened is, this one here, if you want to show like interest rate increases by 0.1%, small amount of 1%, what happens to the other bond price? So if you use that one here, so the P divided by P is equal to what? Minus D, D0, D star. This one, oops, wait. Okay, here, here, minus this star is this one, times minus this star, times change in interest rate, the yield to maturity. So how much is the change? 1%, 0.1%, right? So just enter 0.1% here. If you put it that one here, it gives you this way. How much? The percentage change in here, percentage change is like when this one happens, your bond value, bond price will decrease by 0.66%, 0.66% decrease. So if you actually give the actual number is this one. This one is this one is if you change that percentage, this much percentage will change for your bond price, right? So then if you change that to bond dollar value, then this one was bond value, and then multiply that by this one here. Look at this. If interest rate increases by 0.1% from 9% to 9.1%, what happened is your bond value will decrease like $6.14. That should be $6.14 in that way. Right. This is what I mean. If you calculate this one here, I mean you will get like $929 something, right? This much less. But you don't have to go through all this one because you have this the formula. So if you use this formula, this star, that's modified duration, and then the price change, the percentage change in your price because of this change, this interest rate change, that will give you minus 0.656%, meaning if you change that to dollars, then your bond will decrease by $6.14. Does that make sense? Did you follow me for this procedure, all of you?
Yes.
Okay. Ellison, Harry?
Yeah.
Harry?
Yeah.
Good, very good. So this one is the bond duration. How to calculate bond duration, and then how to apply this one, how to apply this modified duration, and to analyze this one. You don't have to do all these things. I mean, you have, for example, you have the bond portfolio. If you are like a bond manager, and your portfolio that you manage has like 200 different bonds or 100 different bonds that are included in your bond portfolio, then you will get the bond value, and then you get bond duration, the portfolio duration this way, right? Then quickly, if your projection is that your interest rate increases by 0.1% next year, then what would happen to my bond portfolio value? Now, right now, I manage about $935.82 million bond portfolio, right? Bond portfolio, you're managing this one. And then your bond portfolio duration is like 7.146 years. Now, if interest rate goes up this much, what would be your like the decrease of your bond portfolio, your portfolio value? That will be $6.1614 million decrease. All right. Without doing this one, you have to do this one for 100 times, and then do additional calculation and so on and so forth, because you have the 100 in the bond. But if you get this the overall number, you can quickly get the effect of the interest rate change. So this one, interest rate increases, your bond portfolio will decrease in value by $6 million, $6.14 million. All right. Okay. Bond management is, this one is like, I did not include the more details, because this one, if you want to do more about this one, you will take a 423. 423, that's the security analysis. Security analysis that include the equity portfolio management and the bond portfolio management. So, but let me just give you brief idea here. If you figure out all your bond portfolio, the duration of your bond portfolio and the bond value, then what you do is you can do this immunization or rebalancing, all this strategy. The mostly immunization is that, suppose in 5 years, you need to produce, you have the cash obligation about $14.7 million. You need to create $14.7 million to take care of your payment obligation. Then what you do is you change, you set your bond portfolio, bond duration to 5 years, and you set your bond duration 5 years and your bond value, creation and the cash value to set it to like $15.7 million. So in 5 years, so you switch, you modify, you adjust your bond duration to 5 years and set the value this way. Then it is called immunization, right? Immunization. So if you set your duration, the portfolio duration to at the 5 years, and then to meet the obligation, no matter what happens, interest rate change, primarily interest rate changes down or up and down, then your target value at duration 5 years will stay the same. Look at this. Interest rate increase to like 8%, 7%, or 9%, whatever it happens, your ending value is 14.7 million there. Because you did this, you use this duration, you set your duration to 5 years, and then you establish the portfolio value that way. So that is important. One of the important, bond portfolio management strategy, because your bank or your company, for example, the insurance company is good. Now, insurance company, they expect about $14.7 million payment obligation in 5 years. Then this insurance company will hire you as the bond portfolio manager. Now, you as bond portfolio manager, you have to take care of the company's the future payment obligation there. Now, since your company has the payment obligation 14.7 million, you have to set in 5 years. Then you set the duration to 5 years, and then you immunize your portfolio value. So no matter what happens, it will converge to that value in 5 years, because you set the duration, bond duration, to 5 years. So that is glimpse, quick, seeing of the bond portfolio management strategy. All right. The bond portfolio, bond duration, interest rate risk, all this one is interesting and fascinating. Right? So there are a lot of bond portfolio managers out there. They use all this basic concept and fundamental and strategies to manage their bonds. Of course, they will be in a more complicated situation, scenarios there, but this is the fundamentals. Okay, and if you want more, you could go to Dr. Jun's the class 423. That will give you very interesting and enjoyable challenge for you. Okay. All right. Let me